What are source documents? They are covered in Chapter 3, Analysing and Designing Accounting Systems. Source documents provide both the evidence that a transaction has occurred and the details of the transaction itself. They ensure that the reports are reliable or free from error and bias. Most cash payments should be made by cheque because they are secure, traceable and verifiable. This is how we all deal with it for VCE accounting. In reality, bank transfers are probably more secure because they're instant. The money leaves your bank account straight away and you can trace it. But traditionally, cheques have been what are used, and so that's what we'll actually carry through. So that's for cash payments. We pay with a cheque. When cash is received, the source document will be a cash receipt. When cash is paid, the source document will be a cheque butt, and a cheque butt looks like this. So you have details of the date, who it's to, what it's for, and the amount. When stock is sold on credit, the source document will be a sales invoice. We know it's a sales invoice because up here, and this is what you need to be quite discerning of, that will have the business's name. And then this will have who we have sold to. When stock is purchased on credit, the source document will be a purchase invoice. Now, it will look exactly the same because they're both invoices. The difference being, we will be the person who actually was purchasing it. So it will say charge to and our business name, and it will come from another business. So that's the difference between a sales invoice and a purchase invoice. You need to really start to be quite onto that because you might get caught out. An order form is a request for stock or other supplies or assets from a supplier. The credit terms of the sale indicate how long the debtor has to pay. So if a settlement discount applies, it will also specify the terms of that discount. An order form, while it's a request for purchase, it usually doesn't, until we receive the goods, that's the source document. So with our order form, when we have been billed, so just say we order 5 chairs, then when the chairs are received by us, they will have an accompanying invoice. We'd usually just attach the order form to our invoice. The invoice is actually the source document. So credit terms of the sale, if we go back to this invoice, if it's a cash invoice, then it will just have down here that there is $0 outstanding. If we've actually made the purchase on credit though, the amount will be outstanding, and quite often down around here it might say credit terms 30 days. So, and if there's a discount amount which will apply. So that's another thing that you just need to start to look at. Really take notice of your source documents, because if you get the wrong one, like if you sort of interpret it incorrectly, it can mean that you completely stuff up the question. So they're really, really important pieces of information. A memo is a source document used to verify an internal transaction. An example of an internal transaction is if the owner withdraws cash or goods and they will write themselves a memo. So we need to, cash can't just disappear from the register, otherwise we might think that we've got someone who is, stealing, if we've got an employee who's stealing or whatever. So if the owner is taking goods out, they will write a memo. Another time they could write a memo would be if they donate goods. So a donation would be if the people for the school fete come along and they give them a hairdryer or whatever, Retrovision, they would actually write a memo to record that, just so that their stock levels aren't incorrect. A statement of account is a summary of the transaction a firm has had with a particular debtor or creditor over a certain period of time, so usually a month. What happens is if a farmer goes into Murray Goulburn, they're not always going to want the invoice or be able to keep the invoice. They're in the middle of something, so they'll have an account with Murray Goulburn, for instance, and they'll just sort of book it up, and at the end of the month there will be an invoice number attached to every single transaction, but they don't have to pay them at the time. They'll just get the statement at the end of the month which says all the transactions they've made during that month, and then they'll pay it. Usually with the statement of account, quite often that will have credit terms on it. So if you've got an agreement to be a creditor, or you're a debtor in their account, but if you've got a credit arrangement with someone, so the farmer, when they make the purchase from Murray Goulburn, obviously on their balance sheet they have an outstanding liability, so it is a creditor. In Murray Goulburn's books, they have actually made the sale and they're waiting for a future economic benefit, so that farmer is a debtor in their accounting system. So to encourage early payment, they will quite often allow, a 5 or 10% discount if they're paid within the first week of receiving the statement. So once again, please make sure that you're looking at all the details. Is there an outstanding balance? Are credit terms offered? And generally speaking, unless you absolutely have got no money in the bank, you would abide by the credit terms because everyone wants the discount.